Hello guys, I welcome you all in my today's video. So today we'll discuss about public limited companies. These can be recognized by the use of PLC or INC after the company name. It is the most common form of legal organization for very large businesses, for the good reason that they have access to very substantial funds for expansion. A public limited company has all advantages of the private company status, plus the right to advertise its share for the sale to the general public and have them quoted on the stock exchange. This means that public limited companies can raise very large sums from public issues of shares. Existing shareholders may also quickly sell their shares if they wish to. The flexibility of the share buying and selling encourages the public to purchase. The other main difference between private and public companies concerns the separation of ownership and control. The original owners of business that converts to private company structure are usually still able to retain a majority of shares. They can continue to exercise management control. This is most unlikely with public limited companies, because most shares will be issued to a large number of individuals and institutions. As investors, these shareholders own the company, but at the annual general meeting they appoint a board of directors who control the management and decision making of the business. This clear distinction between ownership and control can lead to conflicts, for example, over business objectives and the direction the business takes. The shareholders might prefer measures that aim for short-term profits, whereas the director may decide to aim for the long-term growth of the business. Perhaps in order to increase their own power and status, many private limited companies convert to PLC status for the reason given in table 2.5. It is also possible for the directors or original owners to convert a business back from a PLC to private limited company status. Richard Branson and the Virgin Group is one of the best known examples. The reasons for doing this are largely to overcome the problem of separate ownership and control. In a private limited company, it is normal for the senior executives to be the majority shareholders. In addition, the owner of a private limited company can take a long-term planning view of the business. It is often said that the major investors in a PLC are only interested in the short-term gains. Short-termism can be damaging to the long-term investment plans of a business. See table 2.6 for a summary of the advantages and disadvantages of a public limited companies. Advantages: shareholders have limited liability. The company has a separate legal identity. There is continuity. It is easy for shareholders to buy and sell shares, encouraging investment. Substantial capital sources can be accessed due to the ability to issue the prospectus to the public and to offer shares for sale, called a flotation. Disadvantages: formation entails legal formalities. There can be high cost of paying for advice from business consultants when creating a PLC. Share prices are subject to fluctuation sometimes for reasons beyond a business control. Example, the state of economy. There are legal requirements concerning disclosure of information to shareholders and the public. Example, annual publication of detailed report and accounts. There is a risk of takeover due to the availability of the shares on the stock exchange. Directors may be influenced by the short-term objectives of the major investors. Legal formalities in setting up a company. All governments insist that certain legal stages are completed before a company may be established to protect investors and creditors. The following documents are commonly required in many countries. First is Memorandum of Association must be completed. This document is of great interest to shareholders, knowing that the maximum share capital means that the relative importance of a single share can be determined. Being aware of the company aims means that shareholders can avoid the businesses that may operate in market and products such as weapons that they may not want to be associated with. Second is, the other main document is called Articles of Associations. First is MOA and second is AOA. When these documents have been completed satisfactorily, the Registrar of Companies will issue a certificate of incorporation. Private limited companies may now begin trading. Key terms. Memorandum of Association thus states that the name of the company, the address of the head office through which it can be contacted, the maximum share capital for which the company seeks authorization, and the declared aims of the business. Second is Articles of Association. This document covers the internal workings and controls of the business, the name of the director, and the procedure to be followed at the meeting. There is some activity. Activity 2.1, Twitter goes public. Activity 2.2, Footy Limited to stay private. This was all about public limited companies and legal formalities in setting up a company. Thank you for watching this video.